first breakfast of this quarter of the year. And yeah, I want to warmly welcome you to the Maria 01 Community Breakfast. Today we'll be diving into startup funding, exploring different options available, and how to create a balanced and sustainable financial structure. Joining me today on the discussion are Christian Kreihils, Jaana Rantanen, and Paavo Räisänen. Please join me in welcoming them. I'd like to ask each panelist to briefly introduce yourselves and the organization you are representing here today.
Hey, good morning, everyone. I'm Paavo, former entrepreneur and startup executive, past 6 years at the Maki VC as an investor. We invest in, we are a Maria 01 Building 5 based fund, and we invest in deep tech and brand-driven startups in the pre-seed and seed stages.
Good morning, my name is Jaana Rantanen from Business Finland, which is a governmental organization for innovation funding and something else, but you are more interested in funding. We have funding for companies and also for research organizations, and I'm working with startups and helping them to find the right path service path in the public funding organizations. Thank you.
Good morning, everyone. My name is Christian. Super glad to see Maria 01 is in full swing, back in full swing after summer. Glad to be here. I represent Danske Bank Growth, which is a part of Danske Bank. It's a unit specialized in servicing the startup segment. And what we do is we do non-dilutive financing and cash management and all types of things companies might need in terms of banking. Glad to be here.
Great, thank you for those great introductions. So let's start with a broad question directed to all three of you. How can startups effectively combine loans, grants, and equity to build sustainable financial strategy?
Yeah, maybe I can start as typically then the equity investors set the foundation for the funding mix. So unless you're able to generate positive cash flows from the day one, then like getting some equity investors in place, and then based on that, then you can get to the grants and in some cases also to the debt financing, but maybe Jaana and Christian can tell more about what is the criteria and what type of cases it's applicable.
As we are a public funder, so we want you to have also private funding before you apply our funding. So we share the risk of the investors and entrepreneurs. So you need to show us that you have already this private funding before you apply. So we can give you public funding, which is, it's not easy to get it, but because we have criteria, quite many. But then when you get it, it gives you more time to show what you can do, how you can develop your business.
Could you repeat the question? I already forgot it.
How can startups effectively combine loans, grants, and equity for a sustainable financial model?
Effectively combine. Okay, I think Paavo nailed it. Equity is always going to be the backbone of any funding mix. The short answer is, it all comes down to your business plan and kind of how you want to build up your business, because different stages are better for different types of funding and so on, and different business models and industries necessitate different types of funding. But I guess we'll maybe dig into this deeper later on. But shortly, you should use all of the three options mentioned here in most cases, but equity is always going to be kind of the backbone, setting the tone for everything else.
Thank you. That's a great overview of the different funding options. Now let's focus on loan financing. Christian, when are startups typically ideal candidates for loan financing in general, and what key factors do you consider when assessing a loan application?
So I typically talk about the 3 C's, being cash flow, cash, and collateral. Those are kind of the 3 things we mostly look at. Cash flow is obviously, the company's ability to generate cash flow, which tells a lot about the business itself, the business model, different risks, and so on. What we typically like to see is that, cash flow essentially tells the story, can the company repay its debt? Because banks want to be repaid in full within kind of the parameters that are set. So cash flow is the first thing we look at. How do the cash flows work in the company? Cash then is another word for liquidity. Does the company have any buffers, or are we the last resort? Typically, we like to see that the company, has some liquidity inside the company because, it's less risk for us, obviously, and that's where equity and grants come in. And then collateral as the last C is banks want to have some collateral on their loan. Tech companies don't have any real assets, meaning machines, inventory, or something else. So we luckily have Finvera and some other European grants that we can use that the bank gets the collateral part catered for. What was the question? When does it?
When are startups typically ideal candidates?
Yeah. So if you meet all of these, it starts with the cash flow. We have financed pre-revenue companies as well, but in those cases, there's been a good visibility into the future cash flows. So it all comes down to a analysis of past performance, but more so future performance. How does the cash flows looking forward look? What's the margin of error? What are the risks? And if all of those look good and there's liquidity and there's collateral, then typically that could work. So this all means that it typically, what we see is it's maybe for companies in later seed, A stage is the most common stage where companies start to initiate these discussions.
Great, thank you. Barbara, from a VC's perspective, how do you view loans for startups, and how does the presence of a loan, like existing loans, how do they influence your investment decisions?
So as I said in the introduction, we are mainly investing in the pre-seed and seed stages, and typically at that point of time, the companies are not yet meeting the criteria that Christian was telling here. So in that sense, it's very uncommon for us to even evaluate companies that have some debt. But if I speak on behalf of later stage investors, so then of course they always want to assess that how healthy is the company, if there's debt already in place, or are they able to repay the debt without using the new investment that they are providing. So no equity provider would like to invest their money to repay existing debts. So I think that's in a nutshell the kind of the dynamics there. But yeah, for us it's very uncommon to see even evaluate any companies that have debt, because usually we come as the first investor, and then usually after that then companies are in the R&D phase applying for the Business Finland money, and then when the company is ready for the go-to-market and is already generating some revenues, then the debt financing comes in play.
But they don't cancel each other out. Like if it's a later stage startup, it's not a huge red flag for a later stage VC to see some debts or loans.
No, if the company is otherwise healthy, yeah.
And I would go even as far as say in some kind of industries, the VCs approach us. If you have a company that's, we see this in the impact seen when, let's take companies like Solar Foods and so on, which build factories, then the VCs actually approach us. They have a case, it has some capital expenditure that needs to be financed. Could we do something here?
Great, thank you. Turning our attention to grants, Jaana, can you outline Business Finland's primary funding services for startups, and when and how startups can apply for them?
Okay, yeah. Where should I start? Maybe I start from the smallest one. So if you have something small you have to do, so we have this innovation voucher, which is a grant for, it's 4,500 euros, and you need 1,500 euros by yourself to do something to develop your idea, and it's a grant. It's easy to get, but we have this criteria for all our funding that you need to reach for the international markets, which has a potential. So you have you have an innovation you want to commercialize. This is number one you have to keep in mind. Then maybe the biggest and most used funding for startups is tempo funding, which is for shortly said, you want to get feedback from your potential customers. What are their needs, so you know more how to develop your product or service or business model. That's a grant, and it's the grant is 60,000 euros, and the total budget for the project is 80,000 euros, and that you can get in advance something like 42,000 euros. And the rest of the money you get when the project is reported for us and used as it should be. And the project might take maybe 3 to 6 months what you are doing, and then the criteria. There are some criteria that you have to fulfill, of course, and you need to have a team, at least 2 full-time persons working for the company. Of course, Finnish company, Finnish ID for the company. And then you need 30,000 euros equity financing in the company, but that's not enough for your own funding for the project. But we want to see that you have the money to go through the whole project plan you have before we make the decision. So. In other words, in every funding decision we make, we can take quite a big risk that the technology or service idea, whatever, it doesn't work in the market, or technology doesn't work. But we cannot take the risk that you do not have the resources, either people or money for running the project, the whole project. So that's one way. Then after Tempo, you normally apply for R&D funding, which can be grant or loan, depending what you need to do in the project. And there's no upper limit actually in those projects, in sense of euros.
Great, thank you. Then we touched upon this already, but let's reiterate. How do these grants complement other funding sources, and what role do they play in the overall Finnish startup funding ecosystem?
As I said earlier, you always need own funding to complement our funding. So we share the risk of the entrepreneurs and VCs. So you need to have own funding always. And that's where we come in. When you can show that you have the funding. Of course, if you have deep pockets by yourself, that's also good. If you have customers who are paying you, you can show us that you have this own funding part also. So that's also okay. But equity funding is the most what we see in these startups. What we finance. So they have already VCs in. Or they have, maybe the money is not in yet, but when we make our decision, so the VCs are also making their final decision.
Yeah, I think yeah, really like playing very like a substantial role in the Finnish ecosystem. The Business Finland R&D loans, especially. I think almost all of our portfolio companies that are based in Finland have applied and have also received funding from Business Finland. I think it's really like a great complementary funding to equity, and yeah, as discussed already earlier, that basically there's always requirement also that you need to have at least 30% or 50% of the project financed with equity before being able to get it. So, but yeah, when you are in the product development phase, I really encourage to like combine equity with the Business Finland R&D loans.
No, I agree. We're very positive about companies going out to Business Finland and taking out grants and loans. They're the cheapest form of financing a company can get. So definitely do that.
Great, thank you. And Paavo, perhaps in a few words, this might be something everyone knows, but there might be someone in the room who is new or have just started thinking about funding and whatnot. So is there something you'd like to say about how VCs do funding and how can you get equity from a VC? Just a few key points to share.
Yeah, so I think well, overall it's good to do the kind of homework and really like think who are the right type of investors for your company at your stage, because there are like VCs in different stages. We are investing in very early stages, like you can have just a team with an idea and maybe some early prototype, and that can be enough. But then some other VCs might require some like really like substantial revenues before they even look at your case. So really understanding these different stages and which VCs are playing in different stages, and then based on that the criteria also is changing. But how the process typically works is that the entrepreneurs are reaching out to us and we kind of make the initial evaluation. How you need to prepare some materials for the investors to explain your company, because we are not able to we get so many like cases in our deal flow during the year that unfortunately we are not able to meet everyone in person. We need to do already some kind of a screening before that. So in that sense, already the investor materials play a significant role, and then from there on it goes to the meetings, and then depending on a case, taking from let's say from 1 or 2 weeks to like some months to run through the process, depending on the complexity of the case and how well we know the team and market, and then some legal DD, and then that's it.
Yeah. Great. And going further in that, so are there other like let's discuss some of the challenges startups face when seeking funding. Each type of funding we have here. So what are the most common pitfalls, and what advice would you give to founders who are just starting their funding journey?
Yeah, for startups in general, I think one of the key things is always to learn as quickly as possible, and that's the same for the like funding also. So you need to kind of before starting the process, maybe like get some advice from the other entrepreneurs who have done it earlier. Really that you understand like what is going to happen later. So good preparation is a key part of it. And if you just if you haven't done your homework and you're like spending time to reach out to investors who are not really like a fit for your case, then you can spend a lot of time for unnecessary work for both sides. I think that's one key pitfall there at least, and really like taking the feedback, being very active, getting all kinds of advices that you can get from the like peers and from the internet. A lot of resources available there.
This was good list already, but what we see in Business Finland is that entrepreneurs, startup entrepreneurs, they quite often, if it's their first project with us, they don't have kind of vision and a good plan how to do the thing, how to get to the goal. And this is also important for us to know what are your plans. I mean, where are you reaching out? And if we believe that you really are going forward and you want to go to the international market, so please think about your vision and tell it to us also. And you don't need to have a exact plan when we start talking. So if you have a draft plan, what you need to do, then we can discuss how we can help you. You don't have to know exactly, okay, I'm applying now Tempo, and then you try to fit your doing that, what our Tempo funding criteria is. Please think what you need to do and then discuss with us, and we will see how we can help you, what part we can maybe give you funding and maybe advice and so on, and then you go forward. And then this is maybe the biggest pitfall I've seen, that you stick your doing for those criteria that we have. That's not the way you should do it, your business. You should do what you have to do to get the goals, and then find out how to find the funding.
No, I echo everything that's been said here. It also applies for us, obviously. I also think you only have one chance to make a first impression, so make sure that's a good one. You are allowed to ask stupid questions, but there's a limit to how many stupid questions and how stupid they are. So with that, I mean, you should do your preliminary research. You should be educated, at least on some level, of the funding type that you're talking about. So that's important. Be prepared. You're allowed to ask stupid questions, but don't come across as, not knowing anything about what's going on. That's just not a good look. Also, what I see is companies go for the wrong type of funding in the wrong time. So understanding goes back to understanding the different funding types, understanding when are they good for you. For example, what we see is companies fail getting money from equity investors. They might fail getting it from Business Finland, then they come to us. And it's like, no, we're not gonna finance you if even equity financiers are not gonna work with you. So understanding kind of the different stages, what works when, being educated, boils down to that, I think.
Great. So be educated, communicate your vision, and Paavo, what's your one thing? Just one. The one thing you want to give, the one advice.
Well,
there's lots of pressure here now. Okay, we don't need to summarize into one thing. Just like there's been so many things said, I was trying to reiterate, but I failed at it. Sorry. There will be a recording of this session, so you can go back to the points Paavo made earlier. But yeah, so many good tips there. Then let's dive into, Christian, your experience with loan financing. What are the potential risks associated with loans for startups? And how can founders minimize these risks?
Well, loans need to be repaid in full. If you don't pay it, the bank has the ability to bankrupt you. So it's quite serious. So you shouldn't carry debt that you cannot pay off. That's obviously easier said than done. But I think if we go back to what are the biggest risks, over leveraging, having too much loan. So if there's some hiccups in your business, are you able to cover it? How do you mitigate that? I think it goes back to the plans. Understanding your business, understanding your needs, understanding what's going to work for you and not. And obviously, the bank and the financiers are going to help you answer those questions. But you need to understand where you are and what makes sense. Because if equity investments, you don't need to pay it back per se. There's no timeline. And even with Business Finland R&D loans, they're much more flexible with repayments and such. So yeah, that's always the biggest risk, that you are not able to, because I've seen good companies get into really bad places because they're over leveraged, or they're just not understanding the terms. If you have some covenants, you need to understand the covenants. So being just super informed about your situation is key here as well.
Paavo or Jaana, do you want to add something, or maybe Jaana, you want to elaborate on Business Finland grants and loans and the possible repayment of those?
As he said already, grants, they are really grants. You don't have to pay them back. So that's why we have to evaluate whether we believe what you are doing or not. And the loans, what we have, they are kind of soft loans in a way. Of course, we evaluate those cases also to be kind of sure that your ability is good to run the project, and you really are aiming high. But if the business does not work, so we can change the loan to a grant, so you don't have to pay it back, unless you are given 70% loan. So then there is we can change to 50% of the loan to a grant. I mean 50% of those 70% to a grant, and then you have to pay only the rest back.
Yeah, maybe a good rule of thumb is that before your business is predictable, don't apply for bank loans. I think that's like very very simple, that you need to kind of know what you're doing, and during the first years it's always like you're not able to forecast. You realize it yourself also, that when you make the plans, and if you're not able to meet the plans, then it's just too early to apply for the bank loans.
Yeah, great. So we've already talked about each of your perspectives on the funding you have and the funding mix, like combining with other types of financing. Just to reiterate, could we still elaborate on the benefits and challenges of combining equity funding with loans and grants for startups' growth strategy?
So the benefit with debt financing is it's non-dilutive. So obviously you as a founder owner, you don't need to dilute your ownership from taking external funding. That's a huge plus if you're able to do it. And some businesses need, or there are some expenses that VCs in particular don't feel comfortable paying for. So that could be if you have a startup that ties money into inventory, working capital, if you have some specific projects that need to be financed. VCs like to invest something that has a high ROI, not so much, the types of working capital and that type of stuff. So in that sense, non-dilutive finance can be a very good mix in a company's finances. But again, it depends so much on what type of company you have. So if you take like Swappy as an example, they're marketplace for smartphones. They're gonna have a lot of money tied up in the phones. That's not something VCs are super interested in financing, and it's also something that's an ongoing need. So those types of companies are actually going to need a bank to finance their growth and so on.
Yeah, so really like combining all of these three different elements, I think, the ideal case is like what Christian was saying, like for example, startups that are doing some physical production, building some demonstration or first like production scale industrial facilities, for example. So then, the challenge is always like how to like make sure that you kind of get all of these parties at the same time over the decision line, because typically then in those cases the equity investors, they are somewhat hesitant before you have some kind of indication from the banks, and then banks are waiting the equity investors to move first. and the same with the Business Finland as well. So it can be like really tricky to navigate this and like making sure that all the parties are moving forward at the same time. But yeah, benefits are obvious, the ones that Christian mentioned already, and then for the early stage companies, I think working with Business Finland. So then for the R&D loans, I think that's like a very essential and crucial part of the funding for the startups, really to avoid too much dilution. That's something that can be like a blocker in the upcoming rounds if the founder's ownership is too low.
And that's a good point I think you make. We don't work against each other. It's not like equity investors are eating up our business and vice versa. We actually work quite close together on different cases to make it work, because as you said, there's the timing issue and so on. So, yeah.
Great, thank you. Jana, is there something you'd still like to add?
Yeah, I was going to say that we can also do conditional decisions on R&D when the entrepreneur is waiting for the signing of papers with VCs and so on. So we can make a conditional if we believe that it's really happening in a couple of months. So it's not that you have to have the decision and money already from the VCs when we make our decision, but we want you to discuss the same time with VCs and us, so it's so we can see that it's happening, and then we can do the conditional decision, and yeah, that's all. Actually, if I may, I forgot when you were asking about the startup funding services, what we have. I totally forgot to say that we also have young innovative company funding for scaling up, so which is all the money is used for business development. It's not R&D, it's totally business development, and it's quite big funding. It's 1 million euros, and then now we have also funding for deep tech companies. We are called Deep Tech Accelerator, and we have a call once a year, and it's also a bit more than 1 million euros in 3 phases. So the criteria is different for these two services, but we do have, and these are the ones that the very let's say very good startups will go through also.
Great, thank you so much. We've covered a lot of ground, and I'm sure the audience still has some questions. So I'm opening the floor for questions, and I'll have my colleague Violetta here behind you running around with the microphone. So raise your hand, and once you get the mic, just brief introduction and ask away.
Hello, nice to meet you all. I'm Shreyas Srinivasan, and I've been working on a startup idea at Helsinki Incubator, and the problem that I'm facing is that it's pre-seed, but we are very capital intensive. We need 500,000, but we know from the calculated projections for cash flow, projected cash flow, we will be able to be profitable within a year and be able to return the investment within 3 years. But yeah, it is capital intensive and it's pre-seed. I'm just wondering how I would be able to navigate this in terms of funding through, because it is sort of a mix of working capital and also sort of pre-seed, the VC sort of thing. So I just wanted to know about that.
What does your business do?
We are Pikalautaus. We are trying to we're trying to do gas stations for EVs, basically, in the sense that we're going to repurpose the existing failing gas stations into electric charging stations, plus sort of food and refreshments for the customers. And we're primarily focused on taxi drivers because they are sort of the majority in the capital area in terms of the EV population?
Yeah. So that's a good question because and interesting to hear what Paavo thinks. But for me, that sounds like that might not actually be a VC case per se, because how the VC math works is, they invest in 100 companies and then one of them returns the whole fund. So it's like a very small number of companies return a huge amount of money. Banking in turn works where our upside is limited. We're limited to the interest rate, but we have essentially the same-ish downside as venture investors, which means that that's kind of explains why we are more risk averse than VC investors. Why I'm saying this is that there are some cases, startups, that might not be, fit into the VC model. They might not be interesting for the VCs, but they might be good cases for a debt financer. So, for example, in this case, if you are actually able to prove what you just said, then you could be a very good case for a bank like us.
We did contact Danske, and they said that we needed to have other stakeholders involved to finance it.
Yeah. That's one of the problems when companies reach out to banks is that a few banks, us and Nordea, we have this dedicated startup unit, and we're perhaps more inclined to look at these type of cases. But then if you just contact the bank in general through customer service, you might end up speaking with some representative that doesn't understand startups at all. So always, if you're a startup, try to reach out to the startup guys. I'm happy to take your contact information and we can then continue the discussions afterwards.
Thank you so much. That would be awesome.
Yeah, for the like a $500,000 funding, so then, well, yeah, it is within scope for the VCs. Then, of course, depending on the case, like is the case relevant for VCs, like Christian was saying. But then also you can consider maybe some like individual, like angel investors or some family offices and so on who might have experience also from the same business earlier. So really like maybe broadening up a bit the search for the money.
Hi, John from Conflink. For the equity and the grant side of things, what are your evaluation criteria for companies that are pre-revenue? And do you have any tips or tricks for companies at this stage?
When a company is like super early, so then how to come up with the valuation, that's really a really good question. I think it boils down to the team that you have been able to put together, the idea all in all, and then also the maturity of the company, like how far you are with your product development and R&D, and how much funding is going to be needed before the company gets to the more mature stages. So really, hard to come up with any kind of like a clear mathematical rule that, okay, if you have done this and this, then the valuation is that. Unfortunately, very much more art than a science to come up with the valuation for the pre-seed stage companies.
When we are talking about Business Finland evaluation, so we want to see that you have a vision, you have a plan, you have a team, you have innovative product or solution, whatever, and you know what are your competitors. We want you to tell us what you already know, and then we will see what you should do, how we can help you to go to your vision. And of course, you have to have the own funding. So you have to show us that you have the resources for the project. What you are because we always give money for the project. We are not giving funding to do whatever you want. You need to show us the project plan for the funding. Actually, you can see the criteria also on our web pages, but I know they are more, the language is more like Business Finland, so maybe it's not also understandable, but when you discuss with us, so you will know more what we want to know. And now we have also new, it's a bit in beta phase, but we have My Business Finland, how you can put all your information about your company, and you can kind of know what we are looking for, and then that's from the company and from the team what you have, and then on top of that we want to see the project plan.
Yeah, sorry, did you ask evaluation criteria or valuation? Maybe I misheard. Evaluation. Yeah. Okay. Well, yeah. Well, for that one as well. Yeah, that really the team and maturity. I basically went through most of it, but the evaluation then boils down to the valuation. So in that sense, although I misheard, I still was talking about the relevant stuff.
And I know there's some consultants that can help with Business Finland applications. Some are really good, I've heard. There might even be some who can help with equity rounds. I don't know, Paavo, your experience working with those, but there are also service providers that can help you with navigating this. So that might be an option to consider if you feel like you don't know where to start.
Yeah, hello. I'm Maria Pirttivaara from Sitra, the Finnish Innovation Fund. So I'm from the financing sector, and with a long career like at Tekes, which is nowadays Business Finland. I would like to give one advice for you so that you can keep your position for negotiations good. Please take care that you pay your tax debts, customs debts, that kind of things, because anyway, finances like Business Finland, they are checking your background. Bankrupts they don't mark you so badly. There are bankrupts happen, and you can perhaps explain, and better to explain that. But if you have tax debts, that kind of debts for the government, then if Business Finland gives you some grant, some loan, okay, at the moment when the money goes to your account, it goes to the other account of the government to pay your tax debts. So please take care of your background now and also in the future. That makes your life much more easier, because nowadays finances, they check your background. It is so easy. It is just normal. They do that, and there are things you might be able to explain, and no problem, but this kind of debts are problematic. Thank you.
That's an interesting point, actually. If there are some aspiring founders here, this is not something you hear spoken about, but one thing I would ask if I were to start a company, is to also understand the co-founder's personal history. Does he or she have payment default or anything like that? Because that type of history can actually make it hard to get different types of grants and loans and so on.
Good morning. My name is Juha Stenberg from Enabler. Basically, we have in our company the mix what you are talking about, not exactly with the same stakeholders, but yeah, 3 VCs, one from Continental, working with Business Finland, first the R&D loans, now young innovative company, and also with the Nordea. I would say that maybe the characteristic for Finland is that, first of all, the valuations for the companies are lower than in the rest of the Europe. And as Paavo was saying, Business Finland is basically the deal maker here, because I mean, probably 90% of the startup would not exist if Business Finland would not be here, because they will take the R&D loans first and things like that. Which also you have to remember that loan comes into the game really early on, probably compared to rest of the Europe. So I wouldn't regard loans as a negative thing. It's kind of like it's built into our system. For example, in our last round, which we did in December last year, we did repay some of the loans to Nordea and then negotiated new ones. And that was totally okay to use the equity for a couple of months and then do it. So I would say that since the valuations in Finland are lower compared to rest of the Europe and of course rest of the world, loan is a part of your financial portfolio. And just live with that. And also understand how it works. You were saying that taxes, one is that your equity cannot be negative. That's one of the things also for Business Finland. You need to make sure that your equity is always positive. So loan is your friend in a way.
Yeah, and there's so many different companies. Some companies can bear debt very early on. For other companies, it might be harder. So I agree with you. It can be very early on for many companies as well.
Hello, thanks. I would like to ask, so from the moment, let's say we get funding for a product idea, and what is the ideal time or the usual time that from product idea to product that you would like to see? I think both from VC and from a grant perspective.
A lot of variation here. So if I think about our portfolio also, so if we're thinking about companies like IQM building like quantum computers, so then it's quite evident that it takes a lot of time to build first one. So then you can be talking about years, but then in some other cases, if it's a very simple software, so you might want to make a first MVP version rather in weeks or months to get some initial feedback from the customers. So yeah, I think really depending on a case and the complexity of the case, like what is the right benchmark.
The same goes with Business Finland's grants. So it's hard to say what's the right schedule for productization. So going to market. So depending totally what you are doing. And the plan you have. Of course, we want to see it's realistic, but we take risks. So it can be one year, 2 year. It can be sometimes even 5 to 6 years. So when we are talking about the research-based products companies, so it's very long, and that's why we have this new funding, for instance, Deep Tech Accelerator, to help them to go to the market faster.
Yeah, hi, my name is Ivan, and I have a specific question to Thomas as one of bank representatives. So, can you please answer, is there any specific threshold numbers to open the discussion from the bank side investments?
Sorry, could you ask again the question? I need to hear everything.
I'm interested in if you can help with any specific numbers that can be considered as any kind of threshold to just start the discussion with the bank. I mean, in Business Finland, there is specific criteria. So you have to have like 20,000 by your own money, and you will receive, if you will meet, this additional side. But what about the bank?
Yeah, so the short answer is no, we don't have any very specific thresholds. Every case is unique, but I can try to give some kind of rules of thumb here. So for one, we typically like to see that the company should have raised at least as much equity as they're applying for a loan. So if you have raised 500,000 in seed, we wouldn't like you to have more debt than that. Typically, it would probably be a bit less. So that's one thing, seeing if you're raising equity, having a balance between equity and loans is one. Then what comes to kind of revenue figures, here also, no, as I said, we financed pre-revenue companies before. In those cases, why we did finance them is that they had really good offtake agreements or some other type of agreements that give us comfort that there is actually going to be cash flow which is going to be there to cover the debt. So again, also on the revenue side, we don't really have anything there. And also to put some words on the scale that we work with, the smallest financing cases we do are like, 50,000 euros loans or something like that, and the biggest one I've done was 35 million euros. So we work in a really, really large scale. And we have so many different products for different situations. So we're capable of catering to most of the different situations if the company is eligible for non-dilutive financing. I'm sorry I didn't quite answer your question, but that's just how it is. Every case is so different, and yeah.
All right, so my name is Walid. I'm a coach and VC. I have a difficult question, and one comment at the end. So the question is, when is the startup investable? So when they should chase investors and when should they chase the business? And the comment is that there's always a cost for doing the funding wrong. For example, just yesterday, one person told me that he's losing his home because he applied for loans. And then another startup told me that, hey, we raised too much or too little funding and now we're out of business. So when should they chase the business? When should they chase the investments? In your eyes, because there are different perspectives here. And maybe it's a case by case, so it's a difficult question.
What do you mean by chase the business?
Basically, find customers, understand, and you actually nailed it. Like, you need to be intelligent. I think that was the most honest thing today. Say, like, don't be stupid, be intelligent about your business, right? Before approaching funding.
Yeah, I think these are not like the opposite things, because usually, like, if you're like doing your business well, then it's just easier to get the funding as well. So, and I think like maybe one thing for the like still for the advices for the like funding like when to like do it, or what to do, right? So really the timing is a key thing. So you should apply for funding when you have achieved something. So you have done, maybe the early stage can be that, okay, you have got some early customer validation and you have put together a great team and you believe in the idea, then that might be a right time for the pre-seed funding. Or then for the seed stage, then you have signed for first customers and you have a good customer pipeline developing there. Then for the seed funding, and then when you're a bit more mature and you've been really having some repeatability, some product market fit in place, then you're ready for the Series A. So really always the business and the customer attraction, those things are coming first, and being really mindful about the timing. So when to run the process. So you should not run the process when you're running out of money, but instead of that, you should be running it when you have achieved something that can be interesting for the investors.
Yeah, and if I continue on that, I think this applies to debt financing and maybe even equity financing. You should apply for money when you don't need it. And that's because in those cases, it's so much easier for you to apply for funding. Because as you said, when you're running out of money, the investors are going to squeeze you. I mean, it's bound to happen in most cases. And with debt financing, I think it's, when you're in a good position in terms of liquidity and so on, that's a good place to start fundraising. And that's why we see many companies raise debt in conjunction with equity rounds, actually. Yeah.
I think that was well said, because you also that you should apply funding or get funding when you don't need it. That's maybe also how you should apply Business Finland funding when you get VC funding. So that's the right time to apply also Business Finland funding, because when you have used the VC already, the funding equity what you get, so you don't have anything to use for the Business Finland funding anymore. I mean, you don't have your own funding anymore. So I think that's the very good advice for you to apply early enough funding, so you know how you will use it, and you will have it. You can do what you need to do.
And also, I think whenever you do financial projections, which you have to do when applying, at least for us and probably the grants as well, and equity investors, try to work with scenarios. I know everyone wants to make these hockey stick scenarios. Newsflash, it doesn't work for most of you. So it's important also to have these super negative scenarios so you understand what does it entail. And it also, you should understand what is your cost structure look like. If shit hits the fan, and in most startup cases at some point it does actually hit it and spread all over. So you want to understand how is your cost structure, what are the costs that you can actually drop, which are costs that you cannot drop without sacrificing the whole business. So, and having, at least with debt financiers, being able to showcase that, even though you believe in your business 100% and this is the track you're going to go in, but if something were to happen, this is how our company would look like in terms of numbers. These are the actions we can take. I think most investors appreciate that type of very honest and forward approach to how you handle with risks and negative outcomes.
Hi, I'm Agiliki from the Tech Nordic Advocates, and we mostly work with female founders and diverse founders, so this is an extra challenge. And I would like to ask, from your experience, what is a good startup or a good company? What are the characteristics that you see in your, for example, VC portfolio companies or in Business Finland or in debt financing that are able to actually leverage the financial aid you had given them? And what are some companies that, do they have like certain characteristics that they cannot actually go through paying their loan or actually taking the startup to Series A or Series B and so on?
For us as a really like early stage investor, the team is always the most important thing, and kind of the background of them and the characteristics of the team, so that we can really believe that this is the team that can conquer the market and go through the good and bad times together. So I think that's really, and we have in our portfolio also, I think there's you need to have some kind of a diversity there in the team, so it can come from many ways, like different backgrounds, different type of personalities, different genders, and all kinds of aspects you can consider as diversity, but really like a complementing founders in a team, that's very important for us.
I'm more or less echoing what Paavo just said. I think diverse team is, and their passion to do and aim for high, and they are also, when they are discussing with us, they are honest. I mean, you can trust what they are saying, and you are kind of on the skin what they are doing. So those are maybe the most famous ones I've seen. And well, of course, shit can hit in the fan also for them, but they kind of they realize it early enough, so they know what to do. Maybe the team is the most important one, I think.
And maybe I can comment still for the female founders. So we have really good experiences in our portfolio. So this year the biggest funding round was raised by Onego Bio, and Maija Itkonen is the CEO of that one, and also the Enfuse is one of the most successful cases in our portfolio, having also female founders, and from the investments that we have done abroad, Strice at Norway also having a female CEO raised a 10 million Series A from Atomico recently.
Yeah, I think what sets good companies apart is the quality in everything they do. Good companies are really good at communication. They communicate internally super well with external stakeholders. So every interaction you have with a good company is going to be of good quality. They're prepared. They know what they talk about. So it comes as a founder in a company, you signal different things, and you should try to make sure that the signals are positive. I think a common misconception in what comes to banking and loans is that we're super oriented on numbers. And that is true. We perhaps use a bit more time on financial due diligence that the early stage VC investors do, but still we actually go very much on the general feeling we have of the company and the founders. So even if the figures look super good, but we just have this bad feeling, something's wrong, we might end up saying no. And conversely, if the numbers don't look super good, but we have a good feeling, there's something good about this, I believe in this founder, we might actually end up financing the company. So ensure that every interaction you have with investors and financiers are going to be positive. You do that, I think, best by being super, super well prepared, and having good communication.
Great, thank you. That's time. It's been a super informative 60 minutes we've had here. Thank you for the panelists for joining, and thank you for the audience for your engaging questions.